I know one of the things that really resonated with me when I started to learn about real estate was the holy grail of real estate investing. When you buy a property, you fix it up, you do a cash out refi, and you've essentially pulled out all of your investment capital. So at that point in time, your returns are infinite.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. Hello and welcome to episode 121. Today's episode started with a question that I received from RPOA member, new investor, and podcast listener to this podcast, Tyler Lyons. He has recently rehabbed a property that he bought that he's in the process of refinancing. And his question was about how much risk should he take on that financing? Should he refi at the cost that he has into it? Or should he refinance it at the appraised value, which was a substantially higher amount? I basically answered his question the way that I would do it myself, which is, take the higher amount and put that back into more property. Then Tyler followed up with a couple more questions, and I realized that really his questions were not so much about what he should do with the property and his refi, but more about what happened 10 years ago when people got themselves in trouble by taking on too much debt. We went into a recession and they lost everything. With that in mind, I thought, okay, Tyler's getting at a much more interesting and serious subject. And I thought, why not bring in two experts who I've had on the podcast before, Rob Minch and Justin Workman, to kind of sit down with Tyler and do some real estate therapy, talk through his questions about financing and just how much money should he budget. Rob and Justin and I sometimes disagree on the type of debt that we should all take on. So I thought it would be a good opportunity to just sit down and share those perspectives. So Tyler, welcome to the show.
Thanks, Brian. I appreciate it.
And Justin and Rob, thanks for coming back.
Thank you.
Yeah, glad to be back.
All right, so why don't we just start, Tyler, with you? I mean, you're a relatively new investor. Give us the elevator pitch on what you've been up to in the past couple of years and where you are right now.
Sure. Sounds good. So I have a pretty busy day job that's challenging and keeps me quite busy. So I'm a part-time investor. I've been doing this for a little bit less than 2 years now. Bought my first property in the spring of 2016. So still certainly learning the ropes and, looking to buy properties with a value add component, fix them up. Rent them out and refinance them and wash, rinse, and repeat and kind of continue the process. So that's a little bit about my background.
So tell us about the properties that you've done this with so far.
Sure. Yep. So the properties that I've done this with so far, most of them have had a pretty significant value add sort of component with them. They've needed quite a bit of repairs. The first property that I bought, just to give you a little bit of background on that, it needed pretty much everything, soup to nuts. Needed a new roof, needed new windows, new siding, new bathrooms, new kitchen, pretty much the whole bit. The next property that I did was in a little bit better shape. That was kind of nice. That one didn't need a whole lot of work. I think I put about $10,000 to $15,000 of renovations into that one. Needed a little bit of foundation work, needed a new roof, some new paint, some cosmetic stuff. So that one was a little bit more ready to go. Took about a month or so to renovate that property and get it online. And the most recent one that I initially sent you a question about is that one also needed quite a bit of work. I've never seen a property that had a floor as crooked as this one. If you were to set a golf ball on one side of the floor, I mean, it would be zooming to the other side of the room quite quickly. Super crooked floor, needed some work on the roof as well. New kitchen, new bathroom, quite a bit of work needed on that property as well. So one property was in pretty decent shape, but the other two did have a pretty significant value add sort of component to it.
Okay, so first of all, where are these properties? Are they in Grand Rapids?
These properties are in Grand Rapids. Two of them are on the west side of town, and the most recent one is on the east side of town.
And how did you find these?
I found 2 of them on the MLS. So I have a realtor that I work with quite frequently. She's great. She hustles. She works hard and helps me find deals on the MLS. So I found 2 on the MLS, and the other one was for sale by owner.
Okay. So that's not bad in 2 years. You found a couple, 3 properties, 4 units altogether. You were able to put some money into them, fix them up. Are they in? Sounds like they're pretty much like new now.
They are, yeah. All 3 properties are in great condition. Newer mechanicals, new roof. They should be ready to go for quite a long time, I hope. So hoping that the capital expenditures aren't too crazy in the future, because I've done a lot of the work that needs to be done up front. So hopefully they're set, and I can kind of let them go for quite a while before I need to make any sort of significant capital expenditures.
Great. Are they rented out?
3 of the 4 units are rented out, and then the newest property is being completed right now. I've actually got an appraisal next week, so that one is just finishing up and should be coming online as soon as next week.
Great. So are you cash flowing at this point?
Correct. Yes, I am. Yep. The properties that I do have placed into service already that are rented out are cash flowing quite nicely.
Okay. And the question that you started with was, when you refinance them, because you would like to get your money back out of them, so you want to do a cash out refinance. The question started out with, should I refinance them, or should you refinance them at the cost you have into them? So take one of the properties. Give us actually, I'll let you ask the question. So take one of the properties and kind of put it into question form.
Sure. Yeah, that sounds good. And it's always, one of the things, just before I jump into that question, I know one of the things that really resonated with me when I started to learn about real estate was, I've heard you refer to it as the holy grail of real estate investing. When you buy a property, you fix it up, you do a cash out refi, and you've essentially pulled out all of your investment capital. So at that point in time, your returns are infinite.
Because you no longer have any money into the investment. Exactly.
So that's great. It allows you to recycle that capital to scale your business and to buy more properties. But when you do that, now you've got a debt service cost that might be a little bit higher in relation to your rent revenue that you have for that particular property. So while that's nice, in the long run, it could be a little bit more risky because your cash flow is a little bit lower because your debt service cost is higher. So
take that term debt service cost, and for our listeners who aren't sure what that means, explain that, please.
Sure. Yeah, your debt service cost is essentially your mortgage payment.
So your debt service cost, and there's a ratio, right, of like the money that you're bringing in from rent compared to the actual money that's going out to pay the mortgage.
Correct. Yeah. So if you look at your one metric that I try to look at on all my properties is my debt service cost ratio, which, like you said, it's the ratio of your debt service cost to your net operating income. So it's basically how much free cash flow do you have to cover your debt service cost. And I think typically commercial banks are looking for 1.2 or so on a debt service cost ratio. As I look across my portfolio, I'm quite a bit better than that. But as I look to finance these properties, it still did raise the question in my mind of, well, I don't want to get overly aggressive with the financing because I want my portfolio to be built to last. I want it to be durable in the face of an economic downturn. So that's kind of the question that I initially posed to you, Brian. With this most recent property that I have the opportunity to refinance this property at appraised value and to pull out a pretty substantial portion of my investment capital. And my initial question to you, Brian, was, okay, for this particular property, should I go ahead and cash out refinance at the full appraised value and pull maximum capital back out of the investment? Or should I try to be a little more conservative and just finance it at the cost that I had into the property?
The difference between both choices is if you were to refinance and pull cash out at just the cost, you would not get all of your money back.
That's exactly correct.
You'd be leaving some equity in the investment.
You got it.
If you were to pull out all your money at appraised value, which was higher, then would you be getting all of your money back out?
I wouldn't be getting all of it back out, but there wouldn't be much left in the investment.
You'd be getting most of it back.
Correct. Mm-hmm. Yep.
And my answer, after looking at just the numbers that you provided me, was that really the difference came down to about $1,700 a year. So, yeah, and my answer based on that was, well, $1,700 more in mortgage payment is not going to be the determining factor between success or failure in this investment. So I would pull out the maximum. Justin, I see you grimacing. So why don't you tell me what your answer would be?
No, you've given the standard Brian answer. Take all the money out, suck the property dry, and just roll in the cash flow.
I think he's still got a 75% loan to value.
No, there's still a good equity portion left. Yeah, and you're probably refinancing at what, 75 to 85%?
Yeah, it would be 75% loan to value.
Okay.
Yeah. So
that's still a fairly conservative situation to be in. I mean,
and it's a 30-year fixed loan too.
Yeah, which I don't love 30-year fixed loans, but they're better than a lot of the other alternatives. That's for sure. I'd love to see you do more of a 15-year program, following more of the Dave Ramsey philosophy, if we want to get back into those topics. But even then, it's tough to do in today's world.
Well, so that Dave Ramsey philosophy, and the 15 is a more conservative choice, a 15-year loan
fixed,
where it's paid back over 15 years. You have a higher monthly payment, but you'll own it free and clear within 15 years. Yeah. My answer to that is, well, if you do a 30-year fixed, you can still pay it off in 15 years. You just make additional payments toward principal. If you're disciplined enough to do that, you should always choose the 30-year, because if you run into any sort of financial bumps, you can always go back to what your 30-year mortgage payment is.
Well, and I guess it depends on what your goals are, because I agree, if you're just going to live off of the cash flow from now till forever, well, yeah, a few $100 a month is great. But if you're planning on retiring in 15 years, well, now you have all of that cash flow at that point in time to subsidize that extra income. So it depends. Do you need the money today in cash flow, or do you need the money tomorrow in cash flow? It really depends on your situation and on your goals and kind of what your philosophy is. I like the 15-year program because it gets it paid off, and in 15 years you really get to reap some of those rewards. I mean, it's painful up front. Your cash flow is not going to be as strong. But when that thing is paid off, you're going to get all of that cash flow. All of that NOI goes straight into your pocket. And I think that's where you really have opportunities to grow. Especially us, we're still fairly young. We're not, in our sunset years. We're going to grow over the long term.
Yeah, and Tyler's, well, you're both probably not too far off, but you're in your 20s, right?
I'm in my 30s.
You're in your 30s? Okay.
Yeah.
Y'all look young to me.
Yeah. Well, and that's the difference too, is what are your goals with this? What, are you trying to grow fast now? Or are you trying to have income later? I mean, it's going to be different for everybody's situation. But in my world, ideally, you want the thing paid off so that you can really have some strong cash flow.
Rob, your thoughts?
I mean, it really does depend on your goals, and you really have to look at what you want to do, when you want to do it. I would agree with Justin in that perspective, but really I like the 30-year because it's more of a buffer if the economy does go bad, and then you're in a better situation. You simply would set up an amortization schedule to get it paid off in 15 years. And as long as the economy's good and you're still doing very well, continue with that and be diligent, working on that schedule. However, if the economy goes bad, you've got the luxury of being able to go back to that 30-year payment, which is obviously allows for, a little more room.
Yeah. So in a way, the 30-year kind of mitigates some of that risk because you don't have to pay as much every month.
But I guess I'd like to make the argument that you're basing your purchase on an APOD that should be conservative in the first place. So it should account for some of those downturn cycles in there where rents may go down instead of up. I mean, over the period of time. So if your APOD works on a 15, you could always go back and borrow on 30 if you wanted.
What if your APOD doesn't work on a 15?
Then pass.
then you shouldn't do the deal, huh?
Yeah, in my world.
That would eliminate a lot of deals.
It would eliminate a lot of deals. And then you get very selective.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. Because one of the reasons that people are able to pay so much for, whether it be residential or commercial property right now is because interest rates are low and they can get 30-year financing or at least 30-year amortization.
Cheap money.
Yeah. It is very cheap.
And
money.
that 30-year amortization, a lot of times, well, in the commercial world, and we're not really talking about that, but I will say this, that the difference between a 15 or 20-year amortization versus a 30-year amortization can really make the difference on whether the investment pencils out.
Mm-hmm. I agree. I'd also like to look at the other side of the coin and look at the amount of interest paid. Because if you calculate that over the 30-year versus 15-year, you're going to pay what, 2 to 3 times more interest to the bank than what you would on a 15-year.
That is true. That is true.
So however, if you're talking about total net to you or total net out of your pocket, where do you end up ahead in the long run?
Right. However, you're putting more money in your pocket.
You're putting more monthly
each
cash
year,
flow.
you're putting more monthly cash flow. Each month, you're putting more monthly cash flow in your pocket
on a 30-year.
On a 30-year. So the interest to me is inconsequential. Because before that, I'm never going to let a loan go for 30 years. It's going to be refied at some point. It's going to be sold at some point. I mean, I bought my first 7 properties I bought on 30-year fixed loans. And I'm like, oh, great. In 30 years, I can retire off the income. No, I sold them all. I sold them all within 10 years. So it didn't make a difference. I mean, how many people actually hold their 30-year fixed rental properties, single families, for that long?
I would if I had one. But I think, again, it goes into the discussion of what are your goals? Mm-hmm. Because if your goal is to live off of that retirement or to live off of that income in returement, then you may want to adjust your mortgage term.
So let's ask Tyler.
And same thing, I guess I've never run the numbers on it. Where do you end up at if you do a 15 versus a 30 and you do a refi every so many years? I've never calculated out what your actual net is after any period of time.
One thing you might want to consider too, I'd imagine, is if you compare the 15 versus the 30, if you did take the 30 and with that additional cash flow in pocket, if you reinvested that as well, now you're going to have more cash to invest in additional properties. If you can get a 10 to 15% yield on reinvesting that additional cash flow that you get, would that be something that you would need to consider in the analysis?
Yeah, what is the opportunity cost of tying up more equity in your property?
Very good point.
Because that equity could be used to build your portfolio. That's what I've done.
And I agree. But with that extra opportunity cost comes more risk. And that's the part that you run into. Mm-hmm. There's never been a foreclosure on a property that doesn't have a mortgage.
There's never been a foreclosure on a property that never, maybe a tax lien foreclosure. But that's not what this episode's about.
Yeah, we're talking about regular mortgages.
Pay your taxes. Yeah. Okay. All right. Tyler, what is your goal?
How to do wormhole.
So my goal currently has been just to a bit of diversification for the most part. With my day job, we've got a pretty good 401k program, so I do save some money in my 401k. We've got a good matching program there, so I do have a nest egg in my 401k, but at the same time, I wanted some diversification amongst my retirement strategy, amongst my assets. So that's one of my initial motivations for getting into real estate, was a bit of just diversification of asset base. And now that I've bought some properties and admittedly have a little bit of the bug, now my goal is to grow the portfolio and to scale it a little bit more and try to get additional passive cash flow is kind of what I'm aiming for.
So given that, Rob, what would you say?
I mean, have you really looked at it in regards to your 5-year plan, your 10-year plan, your 20 and your 30-year plan, and where you want to go, and how quickly do you want to scale it? And I mean, what can you say to that? That's a
great question. I'll admit I've not put pen to paper a whole lot in terms of like looking like really far ahead in the future. It's been a bit more of just analyzing deals, looking at it just more on a one-off deal basis. Okay, does this deal make sense? Because right now I'm just trying to, acquire good properties.
At what point do you want to retire from your day job?
That's a great question.
And your boss is listening.
Right. Right. That's a really good question. And that's something that, I mean, currently I do like my day job. It's a really solid company, solid role. So no plans to retire from that anytime soon. But admittedly, at the same time, I do really enjoy real estate investing and enjoy buying properties and fixing them up. And I really enjoy the passive cash flow as well.
That's what I like the best.
Mm-hmm.
I agree. Although I like the rehab portion quite a bit. So
it's fun.
All right. Well, let's go on. So what my answer was to your initial question, and I said, look, you're talking about the difference, $1,700 a year between refinancing and pulling cash out at the cost you have at cost versus at appraised value. Mm-hmm. And then you came back with more questions, which is what prompted this podcast episode. Why don't you just kind of give us a sense of what those questions were?
Sure. Yeah, that sounds good. Yeah, because we got talking about that initial property, right? So we were talking about, for this individual property, should I refinance this property at full appraised value or not? But after you responded, I got to thinking a little bit more, and it's like, well, really, when I think about my risk and really when I think about going into the future, I have a portfolio of properties that I'm dealing with here. It's not just this one individual property. So I started to look at my portfolio in total and started to kind of ask myself and Brian some more difficult questions. And given that I'm a relatively new investor, I've been at this for less than 2 years, I didn't invest in the downturn. I didn't invest 10 years ago when things got really, really bad.
You're a post-Great Recession investor.
You got it. So I've seen really only the good times. So I started to ask Brian some additional questions just so I could try to gather some additional perspective from somebody who actually did invest through the downturn. So one of the first things that I asked Brian, and in turn some of these questions got forwarded along to Rob and Justin here for us to all collectively think about. But one of the first things I asked was, what kind of debt financing arrangements got investors in the most trouble during that recessionary period? So not sure if the group here has any sort of...
They don't exist anymore.
Okay.
Well, Rob, I think you're suited to answer. Let's start with Rob, because you're suited to answer this, because you were brokering loans leading up to that period.
Many of those programs are not around anymore at all. So I really don't see any problem with that. I mean, essentially, you're going to get a fixed product today, and
Was it the floating rate, negative amortization type loans? That
there was a lot of
zero down,
interest
110% loans.
Zero down, stated income.
Value, yeah, stated income.
No income.
Stated income, which is you don't need proof that someone has a job or has income. They can just state it on a form.
Correct.
And that was good enough at the time. And that does not
at
exist
100%
anymore.
financing. There you go. I mean, and those programs are no longer, around.
Yeah. So if you got a 30-year fix, but it was based on stated income, and then it turned out you didn't have that income and you weren't able to pay your mortgage, well, then you go into foreclosure.
And again, there were like 228s, 327s, meaning they were fixed for 2 or 3 years, and then the rate adjusted, and then people couldn't afford the payments. And again, those programs are now really not utilized or around anymore. I mean,
they're coming back. The adjustable rate mortgages are advertised more and more again
they
as
are
a viable product. I mean, people have a very short-term memory, and they've forgotten about the bad.
I would say be wary.
And it seems like we're clearly in a rising interest rate environment right now too, right? I mean, the Fed just announced more rate hikes this week, I think.
Yep.
So
They did.
yeah, I think it's something that people definitely need to be wary about, I'd imagine.
Yeah. I think the other aspect that gets people into trouble that's still out there today is when they bundle all of these single properties into a commercial package. I think if you stick with a single property, single mortgage on a fixed rate for a fixed term, I think it's a very safe environment to be in. As long as you make the payments, as long as you don't do anything funny with the deed and transfer it from LLC to LLC, you own it in your name, it's fixed, you're clear to go. But I see a lot of people now, they have 4 or 5 properties, they bundle them together in a commercial mortgage. Well, now you have a balloon payment after 5 years or after 10 years. So now what happens if the value of those properties drop in 10 years and you can't get a refi to pay off your balloon? I think that's the only situation now that I see that could get some people into trouble.
Mm-hmm. But with what Tyler's doing, putting his properties into 30-year fixed mortgages at what, 5% or whatever,
yeah,
I don't think any of us see any real risk there.
No, there's not a major concern because they're locked in. You're locked in at the rate. You're locked in at the payment. As long as your APOD works out and you do have the cash flow to cover everything, I think you're in a fairly safe investment.
Mm-hmm.
Agreed.
Good. Does that give you comfort, Tyler?
That is very helpful. That is very helpful for sure.
Okay.
I mean,
we've done our job.
There's no perfectly safe investment, granted. I mean, the whole neighborhood could turn.
Mm-hmm.
I mean, rents could go to nothing. I mean, there are possibilities out there. But as long as you're managing the property, you know the neighborhoods, you can get out before disaster strikes, in my mind.
Yeah, and I would say you're investing in Grand Rapids, which is a great community to be investing in. A lot of economists are saying we're going to be doing just fine for the next 10 years. But there's also the demographic trend too, which is there's just more and more people who need housing, and there's not enough housing to meet that demand. So from that perspective as well, from the demographic trend and the local trend of the local economy, I'd say you're in a pretty good place as well.
And I think it's going to help you that you own these already, because as interest rates grow and rise, the affordability changes of housing. So now people can't afford as much house as they could 2 years ago. So that will make an impact if rates continue to grow. I mean, even if we get to our national average of 6 to 7, somewhere in there, I mean, it's still going to cut some people out of the purchase market, and they're going to be stuck as renters. So you're in a good place today.
Definitely. Were there other questions that went along with that as well?
Yes, there were other questions. So that's helpful to know that, with a fixed rate, fixed term mortgage like this, it feels pretty stable, pretty safe, and good to know too that it seems like it wasn't people who were in these fixed type instruments back in the recession that really got in trouble. So that does kind of lead into my next question. When you look back at the Great Recession and the struggles that people had back then, are you aware of any investors who did have a conventional fixed rate, fixed term mortgage who still got in trouble even though they had a good kind of solid fixed mortgage? Or was that really more just the people who were financing a bit recklessly with some of the instruments that you mentioned earlier, Rob?
I'd say primarily just using the non-fixed products. There are some people that mismanaged their properties and got into trouble, but primarily it's definitely the people that used the crazy financing that really got in trouble.
Mm-hmm.
You did see others, though, that had the fixed rate mortgages that had a unit go vacant and they couldn't fill it for a couple months. They didn't have the capital reserves to continue to pay that mortgage, or they didn't have the capital reserves to put into that property because they may have lost a job, but they've lost their outside income. There were some circumstances out there too where people that had 3-4 houses all of a sudden are in a bad spot because they don't have their household income now and they don't have a tenant in paying rent, so now they can't make their mortgage payment. So there were those situations as well. Because even though the property can stand on its own, when it sits vacant for 6 months because nobody's renting, it could definitely put a hurt on your situation. That's a
really good point, and something that I think somebody newer like myself probably needs to think about. You mentioned reserves. I've been in a bit of acquisition mode and growth mode, buying more properties, fixing them up, renting them out. So I imagine something I probably need to start focusing on a bit as the business kind of matures a little more is having those reserves on hand.
That up.
Yeah, absolutely. So I don't know if either if you each have, you know, a certain metric or a certain amount of reserves that you set aside per door, just in the event that you do have some vacancies or you do have an issue or some sort of emergency, like what kind of reserves or cushion do you think feels good for your portfolio?
I think as far as your mortgage goes, I would have 6 months of mortgage payments. Just that gets you through a lot at a minimum. Now you still need to have reserves for capital improvements and maintenance. You know, all of your normal operating expenses you should still keep maybe 3 to 6 months of around at a minimum. Now your CapEx accounts should grow as you hold the property. So that's gonna, you know, depend on what needs improvement in the next so many years. But I would try to hold 6 months of mortgage payments in a reserve account just to be safe. Because if you do have a downturn and nobody's out there renting because nobody has a job, you can run into that problem where it sits vacant for a few months, you know. And same thing, during the downturn, rents dropped, you know, I think a $75 to $100 average per month. So you can have some of those issues with some sort of downturn. You can usually somewhat see it coming, but it does happen.
Yeah, and you want to make sure that in the downturn you do have those reserves, because the people I was able to pick up properties from during the downturn let the properties go because they couldn't put money back into them to make them nice enough to attract decent tenants. So the quality of the property went down, the quality of the tenants went down. Eventually, the owner was not able to make cash flow and make their payments.
Gotcha. That makes sense.
And that's where it's a good time to have extra capital around, or to have a surplus of equity into properties, because banks were still lending, but they were very selective on what they were lending and who they were lending to. So if you have that equity, if you have that extra surplus of cash, you can buy some sweet deals. And that's what kind of the three of us were able to do at the time, is we picked up some great deals that you wish you could replicate today.
Yeah, absolutely. Yeah, and we'll get into the CapEx and the numbers in a moment, but I want to continue with your questions, see if there's anything else that I haven't that we haven't brought up yet.
That sounds good. So this is again just kind of building on the whole discussion around the downturn and just making sure we're protected and we're solid in case things do get bad again. And one of the things I was wondering about is, in the event of a downturn, if your note is performing, if you're making those payments, can a bank call a note on you if you're making your payments, or is that
not on a fixed 30-year product? Absolutely not.
Okay.
Or a 15-year.
Yeah. I'm sorry, I apologize. Any fixed product, no.
Residentially,
Residentially, 1 through 4 units. Correct.
Yeah.
As long as it doesn't have a balloon.
Right.
Yeah, exactly.
Which typically you don't have with those products. But there are some out there that'll be a 30-year fixed mortgage with a 10-year balloon, or a 5-year balloon.
3, 5, 7,
Yeah.
10.
So just make sure there's no balloon payments in the middle.
Right.
You want to stay away from that.
Yeah, so let's be clear though. So in a 30-year fixed residential type loan or a 15-year fixed, the bank is only looking, or the lender is only looking at whether or not you're paying your mortgage, right? They don't care whether it's sitting empty and you're not collecting rent or your expenses are too high. They only care if you're paying your mortgage. In the commercial world, 5 units or more, then the lender really does look at all that. They do look at your debt service coverage ratio, and they want to make sure that you're making enough money to pay your mortgage and that you're not pulling that money from somewhere else, like a personal account. And if they see that happening, they have all the fine print in the contract saying they can sweep your account and take over the property. But what you're describing, what you're looking at, Tyler, is, in our opinion, entirely safe.
Yeah.
As long as you pay your mortgage.
I guess I'd like to add just one caveat to that. A lot of times what people are doing is they're financing these properties in their personal name, because you can do up to 10 of them through FHA and stuff. Now, it's not common practice today to do this, but a lot of people take those properties after they're financed, put them into an LLC. Technically, it could violate the due on sale clause. Now, I don't know of any situations where it's happened, where the banks have called that back, but it could be an issue. So be wary of that situation as well.
That's true.
He's correct. It's technically possible, but I've never seen it.
Well,
No.
but if a lender gets in trouble, let's say your bank that you're borrowing from gets in trouble, and they need to call and they want to figure
They
out,
need to
well, can we
collect
call
as
in
much-
some of
Sure.
the loans? Is there a technicality that we can call it in on? That would qualify as a technicality.
Yeah.
They could
Now, one's not
leverage.
owned by Tyler; it's owned by Lions LLC. So just be wary of that, because a lot of people do that to diversify their risk a little bit, but it could violate a due on sale clause.
Right. And you're not saying they shouldn't do it. You're just saying that be aware of what the
Just
the
be
risk is.
wary
there.
of the risk. Right now, it's not a common practice by any means to do so. But if we do have a recession, all bets are off the table.
Yeah.
And
never know.
a bank scrambling for money, they're going to grab it wherever they can.
It's a good point.
So
All right, so be afraid.
be very afraid.
Because banks will do whatever they have to when their back is against the wall, like it was during the recession.
Yeah, when you're drowning, you're going to grab for every little piece of driftwood you can find to pull yourself above water. So if they can find it, they're going to. But I know that's a common practice amongst most investors now, is they'll do the actual financing in their personal name because they can get a better rate, a better deal. And then they quick claim it back over to an LLC for the asset protection portion. So
Yeah.
just an additional point.
What else you got for us, Tyler?
Yeah, so similar fact pattern. We're talking about things get kind of bad here and what might happen. So again, conventional 30-year fixed sort of mortgage or 15-year, that's what Justin wants. So let's pretend that home values go down, home values decrease. So currently, when I look at my properties, they're all financed at around 75%, 70% loan to value. But let's pretend that the market kind of goes down, house values go down, and now all of a sudden you feel good one day, but now all of a sudden you're underwater. With this type of debt instrument, could a bank make you give in a capital contribution in order to not be underwater anymore? Or is that unlikely with that
Residentially,
type
no.
of- okay. Okay.
Yep, you're safe on that end. You won't be able to do a refi or anything like that, but
Sure.
as long as you continue to pay those payments all the way through, you're going to be fine.
Okay.
With that type of mortgage, with the standard residential mortgage. That's where I talked briefly about the commercial mortgages, where you package 4 or 5 houses together and get a commercial mortgage. Now that's where you have an issue, because now your values don't meet their 75% criteria. So now you've either got to do a capital contribution or you're going to refinance at a lower point. So you've got to put some money into it. Mm-hmm. That's where people end up hurt quite often.
Gotcha. That makes sense. And we talked a little bit about debt service coverage ratio earlier. And again, I think commercial banks are usually looking for like 1.2 or so. But when you look at your personal portfolio, I imagine we all probably aspire to have something a little bit better than just the bare minimum. So do you have a certain debt service coverage ratio that you're looking for on your personal portfolio with your loans?
I
I don't want to owe any money, so a different ballgame.
That's kind of a personal question. That's a preference.
Yeah.
I know a lot of very successful guys that have always wanted 50% equity into everything. Mm-hmm. They've done very well. And I know other successful guys that don't want any equity because that's the way they operate, and they've done very well. There's other guys like me that don't want to have any debt at all, and they've done well. So it's across the spectrum. Mm-hmm. I mean, it really comes down to a personal feeling of what you're comfortable with, what your risk tolerance is.
What's your comfort level?
Gotcha.
Yeah.
Your personal comfort level.
And I think it comes down to what opportunities are out there. Mm-hmm. Today, opportunities are harder to come by. Mm-hmm. So are you willing to take a little bigger risk to get some cash flow, or are you going to not take any risk and not have any cash flow? I think it really depends on your personal preference and your personal goals of what are you after? What are you trying to get out of this in the end?
Right. Yeah, definitely want to continue to kind of build that passive cash flow, but at the same time, be financed conservatively enough to where I'm not losing sleep if things really start to get bad in the economy, because I want to get additional passive cash flow, but at the same time, I never want to have to give these properties back. I want to make sure they're solidly financed. And when I look at across my portfolio with this most recent property, even if I do finance that at the maximum loan to value and pull out as much investment capital as I can, after doing so, the debt service coverage ratio on my portfolio, given my current assumptions, we can maybe talk about some of those in a little bit here, but given my current assumptions, the debt service coverage ratio on my portfolio would be about 1.7 or so, which to me, it's like, okay, that feels like it's probably decent.
That's pretty conservative.
Do you feel like if you do pull the money out that you're going to be able to find another investment that you're going to feel comfortable with those numbers right now, currently?
Mm-hmm. It's getting harder and harder to find them. I mean, there's no question about that. Between my realtor kind of hustling and relationships with wholesalers and, just continuing to look and analyze a lot of deals, I think there still are some deals out there to be found.
Okay.
It's just, I think you really just gotta hustle and get that many more offers in and analyze that many more deals and, network as much as possible to really try to get.
Do you have time to do that
pipeline.
with your full-time job?
It's a challenge.
Okay.
It's a challenge. Yep. It's a challenge, which is why, it's good to have a realtor who's really willing to, kind of bust her tail and, some of their other relationships as well.
Okay.
Well, and I think you have another factor going on today too, is as the economy's picking back up and continuing to grow, our interest rates are rising. So that's the other factor that plays in of, do you take 50 grand less and then a year from now you want to borrow that 50 grand? And well, now you're going to pay a higher interest rate. So what does that truly cost you in the end? So I think there's some other factors that you've got to consider today is where do you think the market's going? Where are you moving to? Like Rob said, what can you find out there to buy, to use that money, to put it to work? Because that's what it really comes down to is where can you best allocate those funds? Is that leaving that in equity? Is that pulling it out and purchasing new? I mean, where are those funds best allocated today? And that's a tough position.
Where are you getting your best return looking at everything overall?
Mm-hmm.
So I'd like to kind of move on to the numbers part and just looking at your numbers and the APOD, the annual property operating data, and talk about just some of the reserves. You had brought up what kind of reserves should you have for expenses and capital improvements.
So yeah, when we first got sent your APOD, basically an APOD, Brian's an expert on them, but it basically
annual property operating data. So it's a spreadsheet that helps you. You plug in your expenses, you plug in your income. It tells you if you're going to make money.
Yep, exactly. So what you need in your APOD is obviously you need your rent. How much are you expecting to get in rent, or how much are you getting in rent? That is your top line item. Below that, you have a vacancy factor. Your unit is going to go vacant at some point in time. You've got to allow for some vacancy factor. It may only be a couple days, it may be a couple months. It just depends on when things are. But plugging that in adds that level of security and helps in the long run. Best case scenario, the thing's occupied for 30 years and you never lose a day of vacancy. You just gain that much more in cash flow. Then you've got to get into some of your expenses. You're always going to have real estate taxes, property taxes. You're always going to have insurance. Do you have lawn care, snow care? Are there HOA dues? There's a lot of other expenses that go into things. Do you have a property manager that's managing the property? What is their monthly fee? Do you have a lease-up fee? Those are things that need to be in there as well. That kind of covers some of the basics that go into it. The other thing is maintenance. There's always going to be maintenance on properties. Stuff breaks as it gets used. So whether it's replacing a faucet or fixing a toilet, I mean, stuff happens. Just repainting a room, it's all part of maintenance. Then you have the other side, which is CapEx, capital improvements. These are your big ticket items. They're your roof, your siding, your windows, your kitchens, your bathrooms, your flooring, driveways, landscaping. These are your big items, big improvements. And I think that's the thing that's most often missed, especially by new investors, and I think by most investors, is they never factor enough money towards capital improvements. And it's kind of hard to figure out, well, how much do I need to put in? And we can kind of go through some of that. But basically, you take your net income minus all of your expenses, and it gives you a monthly cash flow at the end. That's what your APOD is basically summarizing.
Yeah, so that's a great assessment of the APOD. But I also want to talk about capital improvements, because that was one of your questions, Tyler.
Correct. Yep. Yeah, because in my APOD, right or wrong, probably wrong, I use an assumption for repairs and maintenance and CapEx. It's all just kind of baked into one number at 1%, and it's probably a little bit simplistic, and it's probably, from talking to you guys a little bit earlier, it's probably a little bit light. So yeah, I'd be curious to know, Justin and Rob, if you have any sort of input or any sort of thoughts on how you go about developing a capital budget when you're underwriting a deal.
So wait, before you go, I think Rob and I, because you've got more to say, Justin. Okay. You've got actual numbers in front of you.
Yeah.
Rob and I will talk about how we do it, but I usually budget, because the properties are older here in Grand Rapids, I'm usually budgeting about 15% of the income toward maintenance. And then as far as capital improvements go, well, I'm commercial, and I do it more for commercial, but you're going to budget anywhere from 250 to, in some cases, depending on the condition of the property, 500 a door per year. And that's my answer. Rob, your answer?
First of all, it depends on where you're at in the economic life of the property. Like Justin's already said, we've got a roof, we've got siding, we've got a driveway. What kind of condition is that in, and where is it at in the economic life? And you've got to look at that accurately and say, okay, I'm probably going to have to do that in X years, so therefore you need to budget that number. So I'm not necessarily going to give you a number, but what I'm going to say is really look at it for where it's at, and and then you come up with your own number based off how you feel about it. But just make sure you've done your research and you're correct.
Yeah. Now I'm kind of the same mind. Like you get a sense of the property through the physical inspection. That tells you where you're going to be putting money into it over the coming years. But Justin he actually has real numbers. He's put a number to everything, and I think he's going to shock a couple people, or quite a few people, with what he has to say.
Yeah, and this is very basic, but I get this question a lot, and I see this mistake a lot. So we put this together real quickly, and basically I just said over a 30-year period. So the length of your mortgage, essentially, if you do a 30-year fixed rate mortgage, what are you going to spend on capital improvements? So I just went down and created a line item of items, gave an estimated lifespan and a cost. So for a roof, I said you're going to get 30 years out of your roof, which is near impossible, but it costs you $7,500 to replace. Windows, I said you're going to get 15 years out of them. They cost $6,000 to replace. Now I'm talking single family. These are basic numbers. You're going to do it cheaper or more expensive depending on the condition.
So your standard single family.
But I'm just saying, yeah. Yep, standard, 3-2 whatever, 1,500 square foot house. Rough ballpark numbers for today. Siding, you're going to do that once every 30 years. It's going to cost you $12,000. Furnace is $3,000 at 15-year lifespan. AC is $3,000 at 15 years. A water heater is $1,250 at 8 years. Kitchen, I have a 15-year lifespan at $5,000. Appliances, 7.5-year lifespan at $2,500. Bathroom has a 15-year lifespan at $5,000. Flooring, I put at $4,000 to do the whole house, and that has a 7.5-year lifespan. Driveway is 15 years at $7,500, and landscaping, I put $2,500 for 15 years. Now, some of those numbers are based on what the IRS allows you to depreciate at. Like your driveway, your landscaping, that's all 15-year depreciation schedule. Appliances are 7.5. So some of those, that's where I get some of the numbers. The other ones are more or less made up of, once my kitchen's 15 years old, the thing's basically shot and it's time to step it up. It's dated, it needs to look a little better than what it is. So it's just my own personal preference. You take your lifespan, divide it out by 30 to figure out how many times you're going to replace it in that 30-year time period, and you come up with a number. totaling all those numbers out, the cost to own that property for a 30-year time period comes to $114,000 and some change. Divide it by 30 years, that means I've got $3,800 per year I need to put into capital improvement fund.
Or at least, so reserve.
Into a reserve.
Put that
Not
into
that I'm going to
reserves.
spend $3,800 a year, but I need to put that money into a reserve fund. So that breaks it down to a monthly cost of $317 and some change. Now it's complex to some extent, but just you've got to sit down and figure out what are your capital improvements and what does it cost to do it. This will just help you plan accordingly, because I see a lot of people that put in $50 a month. Well, my number here was over 300. Obviously, it's not going to cover those costs. And granted, some capital improvements will need to be done sooner than later. I mean, on a property you purchase, the roof may be 10 years old, so you may get 20 years out of it. But you still need to plan accordingly to put that money into a reserve account to do it later. And you're not going to necessarily spend all 115 grand today, but over that 30-year lifespan of the note, you could definitely spend that much or more, depending on your property.
Easily.
No question.
Yeah, and I think what's interesting about what you just gave us is you've given us a very good rule of thumb for single-family investment, how much money you should be reserving each month, which is about $300.
Yeah, on a single-family property, I think a $300 number is a safe place to be. Now, granted, if you're buying a property that has some capital improvements you want to do in the near future, you need to budget that into your kind of acquisition cost on the rehab side of, say, you're going to do siding, windows, and a roof in the next 5 years. Well, that needs to kind of go into more of your upfront cost of the property versus just keeping it in capital improvements.
So would you say with Tyler, who went into these 3 properties, 4 units, and did a lot of the work up front, a lot of the capital improvements were done upon acquisition, that's a pretty good budget for him, because it's taken into account the next 30 years. Because even though he's put a new roof on the property, in a 30-year period, he needs to start budgeting for.
He's got to put another roof on in 30 years if you can get one to last that long. Same thing, in so many years you're going to need to do a new kitchen again, or new bathrooms.
And if you bought a property that had a roof that was, let's pretend, 10 or 15 years old, in that calculation you just did, in theory, you're going to be setting aside more money because you're going to have a shorter life on your roof repair when you're calculating what your replacement cost is that you need to set aside, right?
Theoretically, the math should somewhat work out. If everything's old, it's going to not work out as well. But if things are spread out enough, you should be safe.
Okay.
You know, say it's got an old roof but a new furnace. Well, the numbers should kind of come together. The worst case scenario is everything fails at the same time,
right?
Which happens. But, but you know these things are coming in the future, so you can kind of plan and budget accordingly. But I think people, when they're first buying properties, do not set enough aside. So all of a sudden it comes to wintertime, they have a major ice problem, and now they need to replace a roof. They don't have any money set aside for that replacement. And you hear that a lot. Well, I've got to replace the roof, my furnace died, my hot water heater's broke, and my fridge died. You know, stuff comes in groups, it always seems like. So you've got to set enough aside to cover all that you think could possibly be coming. And some of that stuff's easy to plan for. And some of it's not a necessity. You know, siding and windows isn't usually a necessity. You can kind of repair them and get by for another year or two to save up those funds. But over the long haul of the property, just based on those numbers, you're going to spend $300 a month over the long haul. Yeah. So it's an important factor, especially when people are not planning on putting money into improvements.
And that's a good number for homeowners too. It's not just for rental properties. It's if you own your own home, you should be setting aside money and reserving it for those types of capital improvements as well.
Yep. And again, just make your own spreadsheet. It's easy. It's just a few lines of input. So it's easy to do, and it should be part of your analysis process on a property. Especially when you're going to hold for any period of time.
So, Justin, when you look at Tyler's numbers and his assumptions, how far off is he?
I'll take one property. I put in repairs, maintenance, and CapEx. I totaled it at $3,700, which
For the year.
For the year.
Repairs, maintenance, and CapEx.
Which is assuming there's not a lot of repairs and assuming there's slightly less capital improvements than what we just went over in the spreadsheet. Initially, you had budgeted in $1,400. So there's a $2,200, just about a $2,300 difference. What that does to the overall property is kind of impressive in my mind. I don't have the original cap rate. Oh, I do here. So initially on this property, you had, leaving all the other assumptions the same as far as what your mortgage payments, etc. would be. Your cap rate was at a 9.5 and your debt service ratio was at 154%. Just by raising that CapEx to what I think is more in line with reality, it changes your debt service ratio coverage to 107. So it was at 154, and it changes your cap rate from 9.5 to 6.6, which is a huge jump. I mean, it also moves your cash flow from $2,600 to $300 a month. So it's a significant jump, not including those things in an APOD. Now, assuming that you're going to do better on these than what your APOD shows, you're going to be fine. You're still safe. But it's an important thing for people to plug in actual numbers into their APODs.
The one thing you could do to sort of mitigate that is, since you're pulling cash out, start building your reserves from that. So maybe get ahead of your reserves by taking $6,000 to $10,000 and starting with that, because you're borrowing it from the bank. It's money you can access directly. That's not a bad way to mitigate that.
Right.
No, and I think overall it's still a good, solid purchase in today's world. You've got a newly rehabbed rentable property that's going to do well for a number of years. So in the near future, you're going to do better on that property than what those percentages are that I gave you, because you don't have those capital improvements. But now if you hold this for the full 30 years, it's going to come closer to those numbers.
Yeah, okay. I know it most likely exceed your original numbers.
It should.
Because you're looking at the cap rate and the debt service coverage in year one.
Yes.
It's like today, year one. But a year from now, you might get that rent up $100 a month. You might lower an expense here or there. I always, the cap rate is just a starting point. It's not the end point, that's for sure.
Yeah, and I think when you do an APOD, I think there's a lot of good APODs out there that will stretch things over time. So you can put some growth rates in, you can put some inflationary rates in. Same thing on your capital improvements. Really, you should have kind of an inflationary factor of, just because it costs $7,500 to replace a roof today doesn't mean in 15 years it's going to cost $7,500. That cost is most likely going to go up. So there should be kind of some inflationary rates if you look at the long term of the property, depending on your hold period.
Forecasting.
Yeah, you've got to forecast out some length of time. It's not just a today snapshot.
Yeah. And by the way, I use a really good analysis software that you can take it out 20 years and see how things change. And if you go to my website, which is higinvestor.com, H-I-G investor.com, there's a resource tab, and you can link to the software package. It's not my software package, but it's the one I use.
Getting a cut yet?
I do get a cut, yeah. So buy it, but link to it off my website. I will get a cut of that.
Say where you bought it from. Yeah.
But it's important to have some sort of analysis software, whether it's a spreadsheet you create or something you pay for. And I think $100 for a really robust software package is a bargain. So go to my website, higinvestor.com.
And I think it's important, just to bring it back, is real estate investing is so much about the numbers, and it's, all the money is made on the buy. Well, this is part of that money making process. Is when you buy it, you've got to figure out these numbers. You get so many people that just kind of go out by the seat of their pants and just guess at all this stuff. They don't put any time into it. They've never heard of an APOD. They don't understand all of the true expenses that go into a property, that they can get themselves in trouble. And at least with you, you've done your homework. You know enough to do this stuff. You're going to be successful in the long run just because you've taken the extra step to put it together.
Yeah. And I think also Tyler's asking the right questions. Just that fact alone shows that your thought process is suitable to being successful in real estate investment.
I'd agree.
All right. Well, Tyler, thanks so much for bringing these questions to us and being willing to sit here and have us scrutinize your investments.
Yeah, not a problem.
You're a brave man, so thanks for doing that. Rob and Justin, thanks as always for coming in and lending your perspective. It's always fun to have you guys kind of give a different perspective than what I might offer. And I definitely appreciate your breakdown of capital improvements as well, Justin. That was, I think that's probably made a lot of people rethink, some of their numbers. Just the fact that they need to start budgeting at least $300 a month for capital improvements on their single family properties.
Yeah, no, I'm glad to be here. Tyler, you're doing a great job. Keep going.
Thanks, good job, Tyler.
Appreciate it, guys.
This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.